Hi traders, good morning, good afternoon, good evening. I'm back again with a video for this week, and this week's topic is options Iron Condor. So today we are going to learn about Iron Condors. How do we create an Iron Condor, and how does this strategy work? This is an excellent strategy for people who are working and who are wanting to have a limited risk and limited profit strategy. The risk to reward ratio in this strategy is really good. That we will cover in the coming slides. So let's get started. Okay, now what is an iron condor? We have learned about credit spreads and debit spreads in the past session and this past videos which I have posted on YouTube. So you can go through those videos to understand how does credit spread or debit spread work. So Iron Condor is a simple strategy where you combine uh, credit spread on the call side and credit spread on the put side and make a short Iron Condor. And if you do a credit debit spread on the call side and a debit spread on the put side, it is called a long Iron Condor. So here I'm given a chart depicting how an iron condor, this is a short iron condor chart, but I don't know why it is mentioned as long condor payoff, which is wrong. So this is how a short iron condor will look if you keep a close strikes, which is like 100 points away. So as I said, very simple strategy. Your risk is limited to this, and limited risk and profit strategy. Your profit will be maximum when the spot stays in between this range. Okay, so we'll go to the live chart and understand this better. Okay, so this was the chart. Let's go to our options analytics tool. Okay, let's get started. So let's look at Bank Nifty options expiry of 24th October and then select the strikes. Let's go to the option chain for Bank Nifty. So the spot is at about 29,120. So we will choose the strikes which are out of the money for creating a short iron condor. Okay, so we will choose a 29,300 and a 29,400. So we are going to sell a 29,300 call and buy a 29,400 put. Let's start 29,400 call, we sell one lot, and 29,500, 29,400. So 29,400 call we sold. Let me just fix this, guys. I goofed up something. So 29,300 we are going to sell and 29,400 we are going to buy. So 29,300 call we are going to sell and 29,400 call we are going to buy. Okay, so this is a credit spread, call credit spread, where the difference of the amount between 279 and 242 is what you have received as your credit. So max profit is 759, max loss is about 1200 rupees. If you are sure that market is going to go down, you can do this strategy. Now coming to the put side, so we have taken one strike away from the in the money option, so we will follow the same system here. We will leave the 29,000, we go to 28,900 and 28,800. So it is 28,900 put we are going to sell and 28,800 put is what we are going to buy. Okay, so now your iron condor is ready. So look at this chart, guys, your maximum loss if the market moves anywhere from 28,818 to anywhere, your loss is always 347 rupees. And if it moves higher from 29,382 to anywhere, it is 345 rupees. Your loss is fixed. Your gain, if the market remains in this range of 28,818 and 29,382, your gain is about 1,600 rupees. So, don't you think this is a good strategy where you are having your max loss defined, max profit defined? How much you're losing? You're losing 350 rupees for a gain of 1,651 rupees, which is a really risk to, excellent risk to reward ratio. And you don't have to do any adjustment if the market remains here. Only adjustment will happen if the market touches any of your outside wings. So here, when the market is coming and touching this side will be in profit. You do a roll up on this side, you close this position of the put, and then roll up the put on the other side if the market starts going up or down according to the market trend, right? So whichever side is untested, that side you have to start rolling up, so that side will be in profit. Never adjust the losing side. So this will give you uh, another premium if you roll up and write another spread here. So that is the way you adjust, and this is the most safest strategy. Even if you're not able to make a decision like what is the trend of the market, where is it going, this is the best strategy to play. In last few days the market has been going here, there, up, down, doing a lot of uh, you know uh, dancing. So this strategy will help you to avoid all the noise and make you some profit end of the day. So if you're a working professional, this is a good strategy. With just one lot you can see you're making a 1,600 profit. Just imagine if you try to increase your lot size to say for 5 lots here, 5, 5 and 5. So what will happen to your PNL? You're losing max loss about 1,700. Your max profit is about 8,255, guys. So this is a killer strategy, guys. Don't you think you should be doing this on a daily basis? Your losses will be like small, your winners will be big. It doesn't matter if you lose like 3 to 4 days, 3 to 4 trades, but when you win big. So your chart will look like this only. Your gains will be higher, your losses will be smaller. So there is a long variation to this also, like which is long. I'll just flip the position, you'll be able to understand. So this is a long Iron Condor where you're flipping your position, you're buying out of the money, and just inverse of the position what we have spoken here. You're going to lose money if the market stays in this range, and if the market moves any side you're going to make 1,700, but your max loss is 8,200 if the market stays in the range. So market can stay in the range. As you can see, in an intraday basis this will be a good strategy. Even if you have a good price action trader, if you have identified what is the range of the market, this is also a good strategy. So let us understand, like let's look at bank nifty chart and see what's happening here. So if you have identified that on a daily chart, if you're a positional trader, you identified this is the bottom level 27,500, below 27,500 and above say 30,000. 30,000 you sell and 31,000 you buy, and 27,000 you sell and 27,100 you buy. So you can play around with these strikes so the market can stay in this range, and your Iron Condor will give you money in the long term. But if you're doing an intraday trade, you can identify the levels in the morning at say about 29,100 till 11 o'clock. You'll be able to identify what are the peaks and lows of the market. So here on this day you can identify 29,100, 29,200 is a strike which you can sell and buy the strike above it. 29,300 here you can see 28,800 you can sell and 28,700 you can buy. So the market has stayed in this range. You could have easily made money from this, but it doesn't work always like this. Most of the time on Fridays especially, guys, you will not lose the premium. So avoid doing iron condos on Friday because there will be like minimum gain. So it is better to do a long straddle on Fridays. Okay, so now let's get back to the presentation and understand what are the rules for creating an iron condor, which I've already spoken. But let's summarize. You have to choose out of the money strikes for credit spread for short iron condor, choose in the money strike for debit spread for long iron condor, which is not that great for execution, but still if you want to try, you can try. I wouldn't suggest that. Completely your call. Width between the strike should be as per the ATR of the underlying. So if you're working on bank nifty, if you want a maximum profit, you can choose 200 width of the strike. That means the strike difference between one strike and another strike has to be 200 or 100 if you want to have a conservative approach and have a lesser loss. So if you look at the chart here, by flipping this position, so this is your width size. If you increase this, this risk will increase. So that's how it is better to keep the width size smaller so that your potential for loss will be less, and adjust by rolling spread on the side in profit. This I've explained already. If the market is going up, your call side will be in loss, your put side will be in profit. So put side, you roll up your put spread and adjust to the market. Also keep stop loss. Well, this is an important one, guys. Also keep stop loss for both the sold call and put. If one stop loss hit, entire position will be in profit or minimum loss, because when the market moves near to your stop losses, it is moving with a momentum, and the call or put which you have bought will have gamma effect, and you will end up in profit the moment the stop loss hit, because sometimes it can move, like it can take out your stop loss and move 10 points here and there. Then you will be in profit or minimum loss. If you see that the market major trend has changed in a 10 minutes or a 15 minutes time frame, you cut the position which is single leg, which is on the other side, like call stop loss is hit, so you have a single call there. Cut that call and maintain the other spread which is as per the trend of the market, so that you will be in profit if the market trends in that direction till 315. So that's it, guys. Happy trading, and I hope you all are making good money from the markets and learning every day. And have a great weekend. Thank you so much for watching.